Ladies and gentlemen, good day and welcome to Cholamandalam Investment and Finance Company Limited Q4 FY22 earnings conference call hosted by Kotak Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Now hand the conference over to Mr. Nischint Chawathe from Kotak Securities. Thank you and over to you, sir.
Thanks. Good morning, everyone. Welcome to the earnings conference call of Cholamandalam Investment and Finance Company Limited. To discuss the 4Q FY22 performance of Chola and share industry and business updates, we have with us the senior management today, represented by Mr. Vellayan Subbiah, Chairman and Non-Executive Director, Mr. Ravindra Kundu, Executive Director, and Mr. Arul Selvan, President and CFO. I would now like to hand over the call to Vellayan for his opening comments, after which we'll take the Q&A.
Thanks, Nischint. So, good morning, everybody. We'll just go through key results for both the quarter and for the financial year, for the last fiscal year. The disbursements for the quarter were at 12,718 crores, which was up by 58%. And for the year, it was at 35,490 crores, which is up by 36% year on year. The total AUM stood at 82,904 crores, up by 8% year on year. And that's basically due to a slightly higher runoff post the moratorium. Net income margin was up at 1,516 crores for the quarter, up 13% year on year, and 5,757 crores for the year, up 16% year on year. PAT for the quarter was 690 crores, which is up 184%, and 2,147 crores for the year, up by 42%. The impact of the third wave on the economy turned out to be muted and much more muted than the previous two waves. Nationwide rapid vaccination obviously kind of contributed to blunting the impact of Omicron and boosting consumer confidence. The company has delivered its best ever disbursals, collections and profitability in Q4. The performance was aided by strong signs of recovery in both auto and the mortgage industry. All major CV OEMs reported double-digit growth in March 22, aided by a pickup in infra projects, growth in logistics and e-commerce, and coupled with easing of finance options. There was a strong rebound in residential housing sales in the current quarter, and this was aided by demand from customers after a lot of deferrals from home buying due to COVID. We just go through, like I said, the disbursements. Basically, I just kind of broadly went through what numbers were on disbursements. So that's basically a growth of 58% for the quarter and 36% year on year. If we take the individual businesses, the vehicle finance business disbursement at 8,785 crores for the quarter, as against 6,153 crores which is a growth of 43%. And for the year, 25,439 crores, which is a growth of 26%. LAP, including affordable LAP, dispersed 1,978 crores for the quarter, as against 1,191, which is a growth of 66%. And the year was at 5,862 crores, a growth rate of 62%. Home loans dispersed 441 crores, as against 538 for the quarter, so it was less than the Q4 last year. And disbursement for the whole year was at 1,571 crores, as against 1,542 the previous year. We've had 3 new businesses launched this year, which is consumer and small enterprise loans, secured business and personal loans, and the small and medium enterprise loan businesses. We've combined made dispersals of 1,515 crores in Q4 and 2,619 crores in the full year. AUM stood at 82,904 crores as compared to 76,518. And we talked about PAT, which for the quarter was at 690 compared to 243. Our PBT ROA was at 4.8% and for the year was at 3.9%, both significant growth over the previous year. And ROE was at 24.6% as against 10.4% in the previous year. We continue to have a strong liquidity position, 5,341 crores of cash, including 1,500 crores invested in GSEC, with a total liquidity position of 13,246 crores, including undrawn sanction lines. Our ALM is comfortable, and we've got no negative cumulative mismatches across any time bucket. The Board of Directors has also recommended a dividend of 70 paise per share, which is 35% of the equity shares of the company, and this is in addition to the interim dividend of 1.30 rupee for a total of 2 rupees in dividends. Asset quality, we'll just talk a bit about the adoption of the RBI circular and revised NPA norms. And we've discussed this before. RBI issued a circular in November 21, directing NBFCs to adopt a tighter provisioning norm, and accordingly from November 1st, we have started tracking daily DPD for agreements which have crossed 90 DPD, and we will continue to classify them as NPA until all dues towards principal and interest are collected in full. RBI also issued a clarificatory circular on February 15th, deferring the implementation date to September 30th, 2022. On a conservative note, we propose to early adopt these norms under IRAC. The ECL model provisions this year is stress tested, and the impact of COVID being built into the PD and LGD computations, and hence the ECL model provisions across stages had increased over December 21. Apart from this, we also factored a write-off of 190 crores for long overdue accounts, where further recovery is expected to be minimal. Towards these, a part of the management overlay of 336 crores was utilized, and the management overlay provisions carried in the books as of March 22 stands at 500 crores. And asset quality at end of March 22, represented by stage 3, stood at 4.37%, with a provision coverage of 39.67%, as against 5.85% as of December 2021. The total provisions currently carried against the overall book are 3%, as against 3.04%, as against normal overall provision levels of 1.75% carried prior to COVID. As per revised RBI norms, the GNPA is at 6.82 and NNPA is at 4.75. This is based on the IRAC criteria. And so we carry 564 crores higher provisions under IND-AS over IRAC. The details of stage-wide assets and provisions also are something we've shared. The capital adequacy of the company was at 19.6% as against the regulatory requirement of 15, and Tier 1 was 16.5. In terms of subsidiaries and associates and JVs, Cholamandalam Security had 40.12 crores in revenue, and Cholamandalam Home Finance had 55 crores in revenue. And two new investments had basically 49.3 crores in PaySwift and 1.5 crores in PayPal, respectively, for the year. So with that, let me stop with a commentary, and we'll be happy to turn it over to all of you for questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Dhaval Gada from DSP. Please go ahead.
Yeah, hi. Thanks for the opportunity. I had 3 questions. First is on the new business. So I understand, this quarter we did about 1,500 crore kind of disbursement. Just, if you could give some perspective in terms of, various vertical, what contributed to this, and for next year, should we just, think about annualized run rate as the expectation for next year in terms of new vertical disbursement? So that's the first one. Sorry.
Okay. Hi, Raval. Good morning.
Hi.
Ravi here. Yeah. So, first of all, whatever we expected, it has come in that line as far as the new business is concerned, if you remember the last earnings call. However, to project the whole year number is going to be difficult. But as you know that under the new business line, we have three businesses. One is the consumer and small enterprises loan, wherein we are actually focusing the customer who are taking the business loan or professional majorly, and little bit personal loan. And then small business that's a secured loan which we are actually giving it to the small enterprises, mini enterprises rather than that, which are actually having a shopkeeper or taking the loan for the businesses. So that's the second one. And third one is SME, which was there for quite some time, and now we have started actually growing that business. So this business put together has contributed 1,500 crore, and obviously the coming quarter the numbers will be better because we are now started expanding in the country, and the CACL business is actually started doing good number. We have 4 partners also available. The partnership business is 33% of the overall business, and the traditional business is almost 66%. So we are getting good traction. The SBPL business is a business which is being done directly by the field team internally, and which is going to be taking time to ensure that we actually understand the knowledge, understand the market dynamics and the behavior of this mini or micro SME. So that growth will be slightly slow, but the CACL and SME started also picking up, and we are expecting that the run rate will improve from the next quarter.
Understood. The second question was on that slide 21. So just question was next year in terms of maintaining the PBT ROTA at about 3.9%, which we did in FY22. Just how the moving parts would be since there would be some pressure on margin and also on credit cost there is some scope for improvement. So I just wanted to hear your thoughts of how you think about maintaining the current level of PBT ROTA. And last is the data point on restructured loans at the end of 4Q and the overlap with the stage 2. Yeah. Thanks.
Yeah. So if you go by the history of Chola, we have been maintaining close to 3.5% PBT ROTA, between 3 to 3.5%. 3.9% is the highest because now we started getting the reversal of the LCL. And so that is going to be continued over the period. At the same time, obviously, the cost of fund goes up, which is going to impact a little bit NIM. So at the ROTA front, we always internally target 0.5%. If it comes more than that, which is going to be a slightly optimistic number, which we are trying also. So though between 3.5 to 3.9 is going to be any number. So NIM impact, it will get impact, offsetted by the reduction in the NPL. And restructured, can you repeat your question?
The stock of standard restructured loan at the end of 4Q, and how much of that is already in stage 2? I think last quarter was 4,000. Yeah.
3,800 crores was the total restructured book as of end of March, and we have 3,362 in stage 2. But as you know, stage 2 represents both stage 1 as well as stage 2 because we present all the books in stage 2 only. So only 444 crores is in stage 3.
Got it. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Rikin Shah from Credit Suisse. Please go ahead.
Hi, good morning. Thanks for the opportunity. I have 3 questions. First one, the OPEX came in higher this quarter and yield also marginally declined sequentially. So just wanted to understand the reasons behind that, and as the new businesses scale up, what would be the outlook for both of that? That's question number 1. Second, on the bank borrowings, just wanted to check what is it benchmarked to? Is it MCLR or repo rate linked, and how often it gets repriced? And third one is just a data keeping question. What would be the total amount of ECLGS disbursements as of today? That's it.
Okay.
Third one,
ECLGS, we have not done any disbursement.
We have not done any disbursement. Out of the bank, if you look at the total borrowings, almost 55% bank borrowings. Rest are all from the market as well as securitization. These are fixed rates, so they don't change. With regard to the bank borrowings, almost 30% would be benchmarked and the 20% would be, I would say 15% would be the MCLR and the balance 5% would be fixed rate. So these benchmark rates as well as MCLR tend to be repriced either quarterly, half-yearly or annually, depending on, mostly MCLRs would be annual. The benchmarks would be quarterly or half-yearly. Sorry, the first question was on OPEX and
OPEX is basically the disbursements are higher and AUM growth is slower. If you see that there is a denominator effect, we are growing faster because we need to cover it up. Like for example, in vehicle finance, we have grown 43%, but the AUM growth is significantly lower. So unless we get back to the AUM or OPEX, will not be apple-to-apple comparison. That is one reason for OPEX, and we also started investing on the new businesses, wherein the growth will come within this financial year. So if you see, once the AUM come back to the normal level of growth of 15 to 20%, obviously OPEX will start slowing down. In terms of percentage, it will become better.
And sir, on this particular point of OPEX, we have added around 7,500 to 8,000 employees in last 1 year. So are we largely done in terms of employee headcount addition, or we would be still adding strategically? And also, any comment on the yield? It declined modestly this quarter sequentially. So any specific reason?
See, manpower is going to be continuous process of hiring and expanding because 3 new businesses now just started, they just started 1 quarter. So within the 1 quarter, we have done only 15-20% of the, total number of branches which is available in Chola Vehicle Finance. So obviously, the growth will not come in 1 year time. It will continue to come. So as they grow, they will continue to hire the manpower. So manpower count will go up. Also, we recruited manpower for collection in order to make it more intensive in the last 6 months. So that is also a reason. But from the collection side, now we have completed the hiring in terms of manpower, because going forward the collection will be little easy as compared to the past. So the ACR is now going to increase, so therefore requirement of collection executive will be less. But the branch manager and sales executive for the new businesses at a new market will be definitely be the requirement as and when we start expanding further.
Also on the NIM, there was a 50 crore adjustments towards the return of assets, and that's where you will see a slight drop. I think that will get corrected as we move on.
Okay, got it. And just as a follow-up on the OPEX, the collection agents that we hired, because now the collections will be normalizing, would you be rechannelizing them as sales executives, or they will continue to focus only on collections?
They will continue to focus on collection because we need to now start working on significantly on the higher bucket where people were busy in ensuring that the X bucket collection efficiency is higher. So once we have achieved that, now they need to go to those accounts which is now going to be target, and we will continue to do the collection with those people.
Got it. That's all from my end. Thank you very much.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal Financial Service. Please go ahead.
Yes, thanks. Good morning, Mr. Vilay and Arul sir and Ravi sir. Thanks for taking my question. So I had 2 questions. First one was again on the newer lines of businesses. While Ravi sir earlier in his comments suggested that disbursements are now going to improve, given that we are now expanding to other branches, other locations as well. But sir, I mean, possible to give some kind of a guidance on how you are thinking of growing this, because I mean, in terms of growth, in terms of disbursements, so like really sky's the limit. So how are you thinking about growing it in a calibrated manner? That's the first question. And secondly, so if you can comment on what is the ROA and ROE that this newer product lines can make for you.
Yeah. So, as I mentioned, the consumer and small enterprises loan has got 3 product lines: personal, business, and professional loan. So, in that we are focusing more professional and business, less personal, and it is being done in 2 channels. One is a traditional channel and a partnership channel. Traditional channel is almost 70%, and partnership channel is 30%. And we are expanding into all our hub. Almost 275 hubs are there and 1100 branches. So this will be almost 70% we would like to cover in this year and 30% next financial year. So to that extent, the volume will keep growing from this particular business. Now coming to the SME, we have 3 product lines. One is the supply chain finance, then the term loan and working capital, and third is the equipment finance. Supply chain finance mainly we are doing in partnership with the fintech and also partnership with the anchor. So that is growing in terms of disbursement, but doesn't support to the AUM growth because that churns fast. But the term loan, which is a secured business, and the equipment finance is a secured business where we have tied up with the manufacturer, OEM, who produce very specific equipment, has got better resale value, and recourse is available from the OEM. We are focusing that to increase the disbursement. So that will be a growth engine for the SME. The small business and secured business and personal loan, which is actually being done as a secured product to the small grocery, general kirana, restaurant, eateries, PM, petty cash, and all those people, is a slow business which we need to learn the business, because that is done only based on the cash flow and the footfall of the customer, where we need to evaluate physically, which is going to be slow, but it is going to be long lasting product once we learn that. And ROI is going to be the highest from this product. So put together all 3, if you make it, then the overall ROA from the SME ecosystem, which we have given in the investor presentation, that we are not present in the bottom of the pyramid and top of the pyramid, rest of the area. We are actually representing the SME. We are there in the SME ecosystem, either with the SDPL or CACL or LAP or a housing loan, affordable housing, and the SME will continue to grow, and the ROA will be equal or higher than the vehicle finance ROA.
Right, sir. Thank you, Rohit sir. And sir, I had a follow-up question on these new lines of businesses, and then one last question for Arul sir. Sir, I mean, you suggested that about 33% of the disbursements in the new lines of businesses are coming from the 4 partnerships. So it is also important to understand here that while all these partnerships can act as your digital DSAs and help you in sourcing and help you in growing disbursements, I mean, how have you addressed the collections part when it comes to loans which are disbursed through these partnerships? That's my follow-up question for you. And for Arul sir, I mean, understandably, we have been very, very conservative when it has come to provisioning, even in the past or through COVID. So, I mean, what was the rationale in this quarter for, I mean, utilizing the management overlay? And sir, maybe a related question also is, I mean, the liquidity on your balance sheet has come down to about 5,500 crores. It's now kind of normalized completely, or is there still room for it to be optimized further? Thank you so much.
Okay. So in order to basically build our D2C platform, digital platform, we need to understand that how these fintechs are working and how is the platform and how the portfolio quality. So in order to learn that, we have done the partnership and we are committed to them. But the credit standard or underwriting norms given by us is very stringent. Therefore, the volumes are not high. And in the beginning, when the overall business is expanding physically or traditional channel, it looked like it is higher in terms of proportion. Over the period, traditional business will be much higher than the partnership business. That is what is the one point. Second is that the collection is very closely monitored. Our collection team working with their collection team to ensure that 100% collection comes month-on-month basis. And as of now, our collection, our performance of this partnership or experience with all 4 partners is very good. And it's a hybrid collection, not that everybody is doing 100% collection. Both the parties, our collection team and their collection team, working together to ensure that the collection is done. and we are ensuring that the portfolio quality of the partnership is as equal to our own internal portfolio. So that is what is the partnership portfolio and the collection performance is concerned.
Sorry. With regard to the provision, I think even in the earlier calls I have articulated that we would be revisiting this provision numbers, because under Ind AS you cannot carry a management overlay without any justification for a large sum. Now COVID is largely behind us, so we needed to revisit this and we needed to bring down. And again, as articulated, we have only taken back some part of it and retained around 500 crores still for contingencies that may happen. Progressively, we keep evaluating this, and we will take a call with regard to how long and how far we need to hold this provision. And the other question is with regard to
the liquidity that we are carrying.
Yeah. So the current way of approach is to keep 2 months of maturities, the next 2 months of treasury maturities and fixed obligations as cash, and the plan for disbursement as undrawn lines. And in that context, with this number will keep varying at every point in time, depending on the maturities that are going to come up in the subsequent 2 months. But it will be in the range of anywhere between 3,000 to 5,000 crores in my view, because that is how the maturities will, we see the pattern right now.
Right, sir. Thank you so much, and wish you and your team the very best.
Thank you.
Thank you.
Thank you. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, good morning. Thanks for taking my question. 2 questions from my end. Firstly, given the kind of current situation, both from the inflationary environment standpoint and the way interest rate cycle is kind of turning, would we like to guide that what sort of AUM growth are we looking at, and over next 12 to 24 months, how the AUM mix will change vis-a-vis our core businesses and new business? That's the first one.
So I'd say broadly we're starting at this stage kind of optimistic on AUM growth. But I would also say that there's enough kind of volatility out there that's very difficult to predict. I would say this year how much real growth is going to be there, especially in kind of our core products and segments. So I think that though in general we do feel confident that we will get good growth, we're a bit kind of concerned about giving numbers because the environment is kind of really getting a bit volatile by the day.
Yeah. In the month of April, industry did very well because last 2 months of last year, April, May was very bad. So commercial vehicle grew by 66%, and even tractor, two-wheeler construction also did very well as against the last year number. Car only has been the flat number. So our disbursement obviously going to be aligned with the industry, and if industry is going to sustain at this level, you will see better AUM growth in this year.
Understood. So my second question is pertaining to our asset quality, and do we have any particular net NPA target in mind for NPLs as per the revised RBI norm, so which is currently at about 475, and some of our peers have been targeting to keep the number below 4%. So do we have any net NPA number in mind, so to say?
I would say we would like to keep it below 4% considering the new norms, and that would certainly be, at least for the current year, that would be the target. We are not too far away from that, so we should be comfortably reaching that.
All right, sure. Thank you so much. And just one data point, what was the total write-off during the quarter?
It's around 380 crores has been the write-off, of which we already carried around 180 crores as a normal ECL provision, and we had a carve-out from the management only of another 190 crores for the incremental provision.
All right.
And that also had a 50 crore impact on the interest line.
Thank you. The next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Thank you. In the opening remarks, you talked about affordable LAP being included within LAP. With affordable LAP, are you referring to SBPL? Is that being included, being called as affordable LAP?
Yeah. The affordable LAP is part of the one LAP division and little bit part of the affordable housing. Both are actually doing the LAP. This is especially in the smaller ticket and smaller town products. They are done at a much better rate than the normal LAP. And we started focusing that product the last year. SBPL will start showing up after some time because we started doing this last quarter only. So that will take a little more time to show up.
Got it. On the OpEx, could there be higher?
Your audio is not very clear. Can I request you to speak through the handset?
Sorry. On the OpEx, so you mentioned that disbursements were high and there are investments in new business which led to the higher OpEx. Wondering that is there also, could we say some sort of one-off impact of the higher collections in this quarter? Or is it only those two factors which you spoke about? The reason I'm asking is that vehicle finance cost to assets is also quite up QOQ. And then new businesses might not be a factor, though disbursements would be. But is there any collection sort of one-off impact as well?
So yeah.
Okay. See, naturally, when collections are good, there will be, performance-driven incentives to the field teams, which would have an impact on the cost that have been factored in. Again, apart from that, even at the salary cost, etc., for the on-roll employees, we have factored in a higher incentive levels considering the higher disbursement and the higher performance as a whole. As you know, even last year we had a similar approach, and last year it was more skewed because we had not factored in the increments, etc. also, and it was factored into Q4. But this year, increments had already been factored in. Only the incentives and based on performance, it will happen. So every time in any quarter, if the performance is low, you will see a drop in the salary cost, and you will see while the performance is good, you will see some spike in the salary cost because this fluctuates with the results of that quarter.
Got it. If you look at stage 1B and stage 2B, they are stable QOQ. Should we see this as a normal sort of level? Because there will always be some people who delay and then go overdue and then come back. And therefore, the decline in stage 2B will come from other assets. Is that the right way to think of it? Or these stage 2B and stage 1B itself, you would expect to fall going forward?
No, you can take. They are not at too high levels. Stage 1B would be at similar levels. It will keep moving, and the stage 1B is the intermediary stage where it is moving from stage 3 to stage 1A. So it has one more installment to get sort of collected from the customers before it gets normalized. So to that extent, it's a good thing that if 1B is a slightly higher number, because it's a transitionary. It indicates that an NPA, an account which had been an NPA, has been more or less collected.
Got it. Understood. Thank you.
Thank you. I request to all the participants, please restrict to one question. The next question is from the line of Subhranshu Mishra from Systematics Group. Please go ahead.
Hi, good morning. Thank you for the opportunity. Just wanted to understand, have we made any representations to the regulator to become a bank, or has in any dispensation, whether a small finance bank or a universal bank, or a regulator has been nudging us to apply for a license or maybe acquire a bank license? Is there that kind of a thought going on, or this kind of a discussion going on between the management and the board and the regulator, or any bilateral discussions as well? And the second question is on the cost of collections. How do we look at the cost of collections in FY23, and what should be it as a proportion of the total OPEX?
So on the bank,
Stage 2, we've been clear on this from the beginning, right? Which is still the RBI indicates in some way that they are open to inviting players like us to become banks. We're not going to initiate anything. And so we've not had any discussions either at a board level or anywhere else till the RBI sets some direction on that front. I think that should answer that first question. On the cost of collection, we think it will remain at the same level in FY23 as it has, because we will keep that collections intensity up in order to ensure that we basically push the NPA levels down, like Arul said, to below 4%.
What would be it as a proportion of the OPEX?
It keeps fluctuating because it will depend on the stage in which it is, because the incentives will keep moving, and I think that's a more granular data which we would prefer to keep to ourselves.
Sure. Thanks.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi, morning, and congrats on the quarter. Just wanted to understand regarding your small business and small enterprise loan in a steady state, maybe 2-3 years down the line. How many branches will you all be doing this business out of? Is it from the same 350-400 branches of LAP, or from the overall branch pool that you all have? And also, how should we think about per branch disbursements on a steady state basis? And if I may squeeze in another question, the performance incentives that you spoke about, does that come only in the fourth quarter every year, or is it paid out quarterly? So yeah, these are my two questions.
Okay. The performance incentive is provided every quarter, but it will reflect that quarter's performance largely. So, for example, in the current year, if you see Q1, we did not have a large amount of profit. Actually, we had a very marginal profit. So, in that quarter, the incentive provisioning would be minimal. In quarters where the PBT achievement, the NPA achievement, the disbursement achievements are higher, in those quarters we tend to take a higher hit on this. So, this is to go with the results of the company, and in which in the pattern in which the teams are rewarded. That's one part of it. The field teams are getting rewarded on a month-on-month basis, while the performance incentive is more of provision, which is carried and calculated and given at the end of the year.
Yeah. So secured business and personal loan, we have given our pyramid of MSME ecosystem in page number 12. You will see that we are in the top of the bottom of the pyramid where this particular business is acting, along with the affordable housing division. So we are actually doing addressing the similar type of customer, where it's self-employed, non-professional customer having the property who they can offer us as a mortgage. So these guys typically do small business like saloon, electrical appliance, eateries, groceries, stationery shops, and their cash flows are calculated when someone is visiting them to understand how is the footfall and all. So these customers are not available in the town where the LAP is performing. LAP is mainly in tier 1, tier 2, tier 3, and they are addressing little larger, bigger customer where the credit history is available, banking habit of the customer is very, very, very clearly established, and the CIBIL score is also can be 100% CIBIL score is there. So therefore, the SBPL will be focusing more on tier 2, 3, 4, 5, 6, and small business, which is what top of the bottom of the pyramid of the customer. 3 to 4 years time, we will be definitely covering almost 70 to 80% of the tier 2, tier 3, tier 4 branches of the vehicle finance and total Chola we have today. And our disbursement will start delivering a good number by the time. As of now, in affordable housing, we are doing almost 200 crore per month. This number has come after 5 years. So affordable housing took 5 years to reach to this 200 crore. I'm not saying that will take 5 years to do, because now we are more learning with respect to the similar type of customers. So we'll do much better than that in terms of learning curve.
Okay, that answers. Thank you, sir, and all the best.
Thank you. The next question is from Shweta Daptardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. So is there any seasonality element in the home equity growth side, because the disbursements have been sluggish and the AUM growth has been slightly modest? I also remember you had mentioned last time, you are also scaling up on the branches side. So any opinion there? And just one bookkeeping question. In the restructured assets, you mentioned stage 1, stage 2 around 3,300 odd crores. How much ballpark number would be sitting in stage 1? Thank you.
Seasonality you already talked.
Yeah, seasonality. The lab business or heavy commercial business is strongly correlated with GDP growth, industrial production, and also to large extent it is also depending on the urban economy growth. But lab, we have also understood that we can approach small ticket size lab like 20-30 lakh rupee of lab, which is available in smaller towns. That's the reason we have started expanding and we are getting benefit out of it. And Suresh, why don't you talk about this?
So from as far as lab business, in fact I've spoken about this in a few of my earlier calls as well. From 250 branches, in fact, from 125 we moved to 250 branches. Currently, we are at 400 branches. So our 20 lakh to 50 lakh ticket size also have increased significantly in the last few quarters. And our investment on both on the branch side as well as on the employee side has started giving us that kind of a growth. Coupled with the confidence in the SME sector now that the things are improving. COVID behind us, and the overall confidence in the SME sector is improving. We are seeing a good traction from our disbursement side.
I would say out of the 3,300 crores, 2,800 crores is the number which is in stage 1, and the rest almost 500 crores is in stage 2.
Sure, thank you, sir.
Okay.
Thank you. Next question is from the line of Shalini from DSP Mutual Fund. Please go ahead.
Sir, good morning. This is Vivek Ramakrishnan. My question was on the various CV businesses where you had nuance in terms of where some collections were lagging, especially those associated with hubs. Given the economic improvement, has the collection efficiency improved across the board for the CV business, or do you still see this lead lag in various businesses? Thank you.
You are talking about the market-wise collection of the commercial vehicles?
Yes.
So, in the last quarter across the country, we saw that the collection efficiencies improved across all the markets. But there are markets which are affected due to the poor mining, or mining got impacted in the Orissa or Bihar because of the sand transportation. In Kerala also it is impacted because of the economy did not do well in the past. But those things significantly improved in Q4, and we are hoping that will continue for the next financial year.
Thank you, sir.
Thank you. The next question is from the line of Alpesh Mehta from IIFL Securities. Please go ahead.
Yeah, hi, thank you. Just two questions. First to Arun sir. Sir, there have been quite a few restatements on the individual line items within the P&L. While the PBT remains the same, but other income and the provisions, there have been few restatements.
Alpesh, your voice is breaking terribly. Can I request you to come in a better reception area?
Is this better now?
Yes, slightly better than before.
Okay, fine. So, Arun sir, there have been quite a few restatements in the individual line item within the P&L between total income and the provision. So, what is it regarding?
Okay, this is based on the advice of the auditors because it would help get a better, tax, claim on bad debts written off. So whatever we are writing off and sometimes we recover something, that was getting adjusted earlier in the end. So they said that it may be challenged, so that's where it is better to show that as an income as a shortfall recovery, and they are now adopted that, and that's the restatement. Actually, I think that's the only restatement. I don't know whether. So it affects in two places. So I don't know if
So basically, are these recoveries from written off accounts or
yes.
Is it any?
When you are getting a recovery from a written off account, we used to adjust that under the NCL itself because that's where earlier the provision of the write-off has been happening. Under the earlier IGAP, that is the normal process. Ind AS allows you, and it is also suggested that it gives a more clarity and more clear view to the tax officials, and it becomes clearly a different line item for them to track. So that's what.
This goes under the other income line item, if I'm not wrong. Right. It does not impact our operating income.
Correct. It won't get into.
It won't go into interest income.
Yeah.
Okay. And large part of this would be related to the vehicle financing company, if I'm not wrong, because the restatements are higher on that front.
Yeah, it is large part of it is vehicle finance. There will be maybe some from LAP. Others are very small.
Okay. And just the last question. During the quarter, the write-offs have been higher. I can see it in the notes to account that you did some accelerated write-off around 190 crores. But even adjusted for that, the write-offs, which used to be around 250 crores, that run rate has increased to almost 350 crores. So, any idea related to that, and will this continue? And secondly, related to this, our pre-COVID ECL was around 1.9%. Currently, we are sitting at around 3%. Since we are moving towards the normalization, by when do you see this number moving back to around 2%? Thank you.
The write-offs, last year we have not done write-offs. So to that extent, there is an accumulation because of last year the COVID was there. So that's the reason today, this year you're seeing a slight build-up on that. Of course, there's also been, a higher levels of settlements, etc. So, but I don't see this will be, as a percentage, it will not be at this level. But in absolute terms, it can be because as we move forward and the book becomes larger, you will see a slightly higher numbers out there. Right? So, with regard to the other part on the ECL provisioning, see, we have built the PD LGDs, the COVID impact into the PD LGDs current year. And so to that extent, the current year PD LGDs are a little bit inflated, though this is more like a one-off event. So this, as you know, we take a 5-year average, so it will take some time for this to, sort of run down when you consider a 5-year average. So to that extent, the impact of this may carry for some time, but it won't be significant as if the subsequent years also trend to be of normal or pre-COVID levels.
Thank you. A request to all the participants, please restrict to only one question per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Param Subramanian from Macquarie Group. Please go ahead.
Hi, thank you for the opportunity. So, first question was on the PaySwiff subsidiary. So now you've reported that the revenues were 45 crore for FY22. So I just wanted to cross-check that because I think in FY21 it was at 200 crores. So, what is the reason for the reduction? And if you could talk about, profitability for this business and how it's going to contribute for the lending, to the lending business going forward. So that's my first question. Secondly, you also mentioned on supply chain finance and fintech partnerships aiding the supply chain finance. So what fintech partnerships are we talking about over here? Is it largely the Threads platform or is there something else apart from that? And you said 1/3 of the new businesses are coming from fintech partnerships. How is it split between SMEs and consumer business? Yeah, those are my two questions.
I think 3 questions. I think your first question, one is gross revenue versus net revenue, right? I think so. Basically, now we're reporting net revenue. Yeah. So it's not a drop. We're just really showing net revenue. The second question was supply chain partnerships. So the question was which fintechs do we?
Yeah. So you mentioned fintechs in supply chain partnerships. Is it largely a Threads platform or is there some other partnership or is PaySwiff already contributing?
We're exploring multiple, including a lot of these there are a lot of these fintechs now that are kind of getting into, the whole B2B supply chain, right? And so we are talking to a lot of those fintechs to try and see if we can do something with that.
Okay. So going back to the first question.
Huh?
So we move on to the next participant. The next question.
One more part. What is the third question? What is the third one? Trade. Trade.
1/3 of the 33% of the business comes from partnerships.
Yeah, so the partnership business which is coming from the
supply chain.
Correct. So supply chain finance is basically keeping the anchor in the center, doing the forward integration, channel and backward integration with the vendor. Is the bill discounting and channel funding. That's a different type of business partnering with the SME. But the CACL is partnering with the partners to mainly do the personal loan, which is small ticket, small tenor loan, and also one form of offline BNPL. And then third is that the traditional PL done in the lead generation happen and we do the conversion. So there are 3-4 type of partnership within the CACL of 30%.
Thank you. The next question is from the line of Varun Nadar from Nippon India Mutual Fund. Please go ahead.
Yeah. Hi. Thank you, sir. Just one clarification from my side, which I wanted. So there was a question earlier that we spoke about the repricing of the liabilities. So I just wanted to understand how our asset side get repriced, depending on market factors, or do we largely do just fixed sort of lending? And if that then differs across products. Sorry, that's all.
So the vehicle finance is a fixed rate book. It doesn't get repriced. The LAP and HL gets repriced. And then we review it every quarter and we do it, depending on market situation.
Okay, so the LAP, your longer tenures would get repriced quarterly. So to that effect, if the liability side does start going up, the risk of a compressing NIM would not be there, at least on the longer tenure loans.
Small ticket size, small tenor under vehicle finance, it is fixed.
Got it.
See that the yield is also significantly higher.
I'm sorry, I missed you there.
Yeah, you are right. We are saying that you are right what you were saying.
Okay, that was it. Okay, that's all. Thank you.
Thank you. Next question is from the line of Abhishek Murarka from HSBC Securities. Please go ahead.
Hello, good morning. So, two questions. One on NIM. Now, if you look at slightly longer term trends, NIMs are pretty much at a high in every business. Incrementally, cost of funds are likely to go up. So, what do you think about the NIMs from here? Can you protect it at current levels, and how does that look? And just squeezing in another one on OPEX. Again, if I look at slightly longer term trends, before COVID, OPEX was roughly at 39 to 40%. I mean, cost to income ratio was 39-40%. Now we are seeing, setup costs for new businesses and, disbursements going up. Do you think from this year 35, we are likely to go up from here in terms of trajectory? So yeah, just those two questions. Thanks.
So the NIM will be in the range of around 7.5, upwards of 7.5, I would say. It is in the way it has been trending on if you look at the last 10 years. It has got the element both from a cost of fund side as well as on the yield side. As we grow our portfolio or diversify our portfolio into multiple products with different yield levels, you will see the impact of NIM fluctuating with which product we focus on. We focus the product based on market, etc. But the impact of such shift in focus is also would be visible in the OPEX and the NCL, because the lower yield products will have lower OPEX and lower NCL, and the higher yield products like two-wheeler or tractor will also have a higher OPEX and NCL. So in a wide diversified portfolio, it is a little difficult to stay, or give a particular range, even a range for a NIM level, because it's better to track the ROTA, which factors in both the OPEX, NCL, and the NIM.
Thank you. Next question is from the line of Pranju Shah from JP Morgan Chase. Please go ahead.
Hello. Yeah, thank you for the opportunity. I had just one question. Based on your current disbursements between the used vehicles and new vehicles, particularly on the CV side and against the current backdrop, could you give an outlook on how do you see the two books moving ahead?
Yeah. So this year, as I mentioned that already in the month of April, industry started behaving very better. And if this has continued, obviously new vehicle business will be higher disbursement, significantly higher than the last year. Last year, the used component were high because the new were low. And as and when new goes up, then obviously the used disbursement, in terms of the proportion, in terms of the absolute value, it will be high, but then proportion between new and used, the new will be higher.
Thank you. The next question is from the line of Vidisha from Antique Stock Broking. Please go ahead.
Thank you for the opportunity. Sir, I just had two questions. In Q4, the yields have come down compared to the last 3-4 years, which was ranging around the 14-15%, and it has come down to now 13%. So how do we see this going ahead, especially when now the new business that we are growing, that should, I am guessing, is a high yielding product. That's my first. And sir, on the restructured book health, if you can give some color on that, and also the provisions that we are carrying on the stage 2 and stage 1 of the restructured book, and what will be your credit cost guidance for 23 and 24? That's it.
So on the NIM, you are seeing that it is coming down. It is like this, like I just now explained to another participant. You have seen that the vehicle finance book is coming down marginally in proportion to the overall book, and the LAP is moving up. LAP has a lower rate. So it will have its impact on the NIM. And as I again told in some part of this conversation, we also had a 50 crore impact on the interest reversal on the write-offs coming into the interest line. So these were the factors. You will see, while in the LAP you will see the OPEX is a much lower number and the income is a much lower number. So it will get compensated, and that's where it's always better for you to track the ROTA in a business where there are multiple products with different yield structures. With regard to the second question, on the restructure, I think we have given enough data already in this call. I think we can't go get more granular on the credit cost of restructure. Frankly, we don't really track that as a separate cost, because the restructured book in our at the ground level is treated at par with the books, and all efforts go on a same parallel basis.
Thank you. The next question is from the line of Prashant Sridhar from SBI Mutual Fund. Please go ahead.
Yeah, thanks, sir. So just one doubt on the vehicle finance. Approximately how much would mature every quarter? Because that also would in effect get repriced at a newer rate, right?
No, vehicle finance, there is no repricing. No, I told vehicle finance is a fixed rate book.
Yes, sir, but there would be some part of the vehicle finance that's maturing in a quarter, and then the new loans would anyway be at the new rate, right?
Oh, maturing, you are saying. Okay, yeah.
So what proportion is that matures every quarter? Because that also would be
almost like almost like 1/3 it should mature in a year.
Correct.
But this would again change with regard to the mix of the book. When you, for example, the coming year you'll do, the assumption of the market, intelligences, heavies will grow. If heavies grow, then it becomes a 5-year book. So then the proportion of heavies will run down only 1/5, and that too in the initial year it will be lower, and then the lag years it will be higher. So whenever there has been if there is a steady disbursement trend and a steady AUM growth, then you can predict this, more accurately. But when you have got like lull, like last year, one whole quarter was lost, etc., and there have been shifts in disbursements, it's a little difficult to predict. But at a very broad sense, you can take 1/3 of the book will run off.
Thank you. The next question is from the line of Bhaskar Basu from Jefferies India. Please go ahead.
Yeah, good morning. So I had a couple of questions. Firstly, just on the broader CV vehicle financing business. So while till March, of course, the fuel price headwinds were not really seen, and my understanding is that so far, at least the larger freight operators have been passing on the fuel price. How do you see that kind of flowing down to the smaller medium, who are basically kind of price takers from the larger vehicle financiers? That's my first question. Secondly, just wanted to understand how's the new book really behaving. So basically, even in December, we had an NPA like 6%, which has come down because the base has increased, even though the NPL levels are kind of flattish. Though these are very small numbers, but just wanted to understand how the quality of the book is holding up. Yeah, these are the two questions.
So in the case of commercial vehicle or heavy commercial vehicle, there are three segments of the product, which is tractor, then haulage, and then tractor trailer. So in the haulage, long haul customer, especially the large fleet operator, they can pass on the rates, and the small road transport operator who are basically having a small need for transportation, they don't worry about the freight charges because they are attaching their vehicle as and when the freight is available and the freight is adequate to them. So only for the long haul customer, these diesel prices are very, very critical because they consume the maximum one. And we are not into that segment. We are into the SRTO where they are transporting in the city and within the state only. For them, it is easy for transferring the price and passing the prices to the customer. For the tractor customer and tractor trailer customer, the diesel prices has not been a problem because as and when the mining operation goes up or the industrial production goes up, obviously they deploy their vehicle depend upon the rates which is comfortable to them. So coming to the point what you are asking, that whether going forward the increased diesel prices will impact the long haul transportation or overall sales of the commercial vehicle or the profitability of the customers. Yes, it can, but it will impact to those operators who are having a long haul transportation and having a fixed contract, and the escalation matrix is tight, and it is not in favor of the customer whom we are not financing. The small commercial vehicle, the tractor, trailer, and construction equipment and the SRTO segment in tier 2, tier 3 can pass on, and they purchase only when there is a ability to buy the vehicle and deploy the vehicle in the market. So that's the commercial vehicle scenario. What we are expecting is that during the time, the construction side, a lot of mining side, a lot of projects are coming up. So therefore, sale of the tipper and tractor trailer is going to go up. Last 6 months, the rural economy was down. It started improving now. The small commercial vehicle, light commercial vehicle, which is strongly correlated with the agricultural growth and, consumption, is going to go up. So we put together, we are hoping that the segment we are focused on is going to increase, and that's the reason our disbursement will also go up.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Arul, just one data keeping question. If you could give us the breakup of restructured loans between stage 1 and stage 2 for the previous quarter.
If you have not right now having it, maybe I can share it with you.
Sure, perfect. Thank you. That was the last question of today's call. We have more than run out of time actually. Thank you everybody for joining us today. We thank management for giving us an opportunity to host the call. Thank you very much. And have a good day.
Thank you. Thanks a lot.
Thank you very much. On behalf of Kotak Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.